I want to go right to the 10-year tips and to the disinflation that is indicated by it. When you see a negative 1.04 in the 10-year tips, what does that indicate?
Well, I think there's a couple of things there. One, Tom, obviously, is that the break even, so the spread between the nominal rate and the inflation-protected bond has actually risen quite a lot since the crisis, and in fact has retraced 100% of the collapse in inflation expectations that we saw. And so, yes, tip rates are negative in yield, but the spread or the expected inflation protection is around 1.5%, up from about 1%. So despite the rate being negative, the real rate being negative, the actual break-even inflation, so expected inflation of the next 10 years, has actually risen to 1.5%. And that's oil prices, that's economic recovery, that's activity restart. That's all the things that have brought, asset prices higher.
Okay, I know with history at Princeton, you have to take 4 years of calculus. That's one of the charms of Princeton. Let's do the partial differentials right now. Which gives in? Do we see the nominal move either up or down, or does the real rate adjust? Which is the greater mover in the next number of months?
Well, it's a great question. And so what we focus on, you have the 10-year Treasury up there, but obviously that has been, the volatility of that has been very, very low. What's been more volatile has been 30-year rates. And so as we kind of approach what we think are the bottom end of 30-year rates, we take a little bit more of a negative view on interest rates going forward, suggesting 30-year rates to be in a range of kind of 150 to 115. So we're closer to the bottom end of that range. So I would say that, yields have this opportunity to move higher, obviously dependent on activity restart. And as you were talking about before this segment of the show, the presidential election, geopolitics, et cetera.
Scott, what happens to inflation 12 months down the line?
Well, I mean, clearly the activity restart is going to be critical. Energy prices, which are very tied to that, is going to be important. There's going to be obviously a period where the economy has suffered dramatically from the COVID crisis. But we would note that on balance, although recently some of the activity numbers, the high frequency numbers have come off, still there has been a relatively strong rebound, obviously, in economic activity. Interestingly, with Europe apparently leading the way versus the United States. So you'd have to expect that over time, as the economy retraces the loss, primarily, as a result of much of the stimulus coming through, we expect the U.S. economy to kind of be back to trend growth kind of in the third to fourth quarter of 2021. That if that's the case and there isn't a, huge impact of additional virus outbreaks, that we get, that inflation begins to move higher. We've been positive on tips, positive on inflation break-evens because of activity, economic activity, but also because the stimulus itself obviously is inflationary over a longer term.
So, Scott, overall, if you look at the composition, for example, of the U.S. economy, where do you expect the longest-term scarring to happen?
Well, I mean, I think it's going to be obviously the number of the sectors that have been dramatically impacted by the shift in activity and obviously the shift in investor and consumer activity. And so, when we look at the equity market, we continue to like things like the quality factor because we see the companies in that bucket performing well given their position and given their their cash flow and the dynamics. I think obviously some of the other companies that are more involved in the sectors that have been beaten down, it's not just about being beaten down in this environment. It's also how do consumer preferences evolve over time. In other words, do consumer preferences shift? So is it safe to travel? That's one thing. Do people still want to travel? Obviously, after the initial surge is another thing.